Hey guys, Mike here. So obviously, what an interesting morning, right? I mean, we get the jobs report, the market tanks, and all of a sudden the market goes, who cares? Who cares if it means the Fed's got to keep tightening? That's just the kind of market we're in, right? I mean, amazing. It just grinded up all day long, right? And it went green at one point in time, but then the market maker said, let's go ahead and end it, max pain, 406s, and try to keep our money. That's basically what happened, right? And we were having a big discussion on that in the Discord right there. And I feel like every time we approach the S&P trend line coming down, they're trying to break, the bulls just do that right there. They jump all over us, right? And this is what took the markets down in pre-market, right? Unemployment comes in hot, still 3.7%, still hadn't made a dent in it. The other big problem was the hourly earnings up 5.09% year over year. Somehow they come up with 32.82. I guess that's the average hourly earnings. And you can see right here in this chart, I mean, this is what Jerome Powell's trying to fight, and he's not making a dent yet. Look at the 1 month change going up for the last 4 months. The 3 month change is going higher now as well. And so this is what he keeps complaining about when he talks about price stability, guys. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. Because what's the biggest expense of a company? It's us. It's the employees, right? And we're still, when you got 1.7 jobs for every one person looking for it, you can demand whatever you want, really. I mean, people are still desperate to hire, right? And not tech companies maybe, but other companies are, which we're going to get into in a minute. And so that's the problem. And that has a big deal when it comes to inflation, because those companies have to pass on those costs. I mean, you've seen freight charges, like to get something from China to here, fall off a cliff, right? You've seen other input costs fall off a cliff, yet for some reason at stores, it's not happening. Well, when you're paying somebody, $25 stock shelves, got to pass that on, right? Or however much they're getting paid. That's just the way it is. And I'm glad they're getting their money. I'm just telling you, that's the biggest fight. And so far, those interest rate hikes, we ain't felt it. They ain't working on that part, right? They're working on like real estate and others, the big ticket items, but they're not working on that, right? We hadn't felt it yet, right? The companies hadn't felt enough pinch yet. And the one thing I want to talk to you about, a couple of things here. One, I want to let you hear an interview with Dan Niles, because people who asked me about that and how I feel about the market and all this other stuff. And I think he kind of summarizes how I feel about it. I try to stay very neutral in here, just to present the information to you. You're all smart adults. You make your own decision. But looking at the data, I think me and him agree on what should happen and what's going to happen short term and what's going to happen, in the first part of 2023. So pay attention to that, and I'll show you the data, some of the data he's looking at, and go, yeah, it makes sense.
What do you foresee between now and the rest of the year for the investment climate?
Sure, Liz. We put out a tweet on that this morning, which is you obviously had a big bump up on Jerome Powell's speech yesterday, which is great, but you're probably going to digest these gains for the next week, but then you get another nice push into the end of the year. We had some stats out on it, and that's the typical Santa Claus rally, right? But I think you don't want to forget about the big picture longer term, which is when companies report the fourth quarter and then guide for next year, every company that I've talked to is focused on cutting expenses. So you're going to see a lot more companies guiding like Salesforce did this morning or last night, and having the stock get hit pretty hard, because that's the big focus for next year. And then valuations are still really high. I mean, the S&P is at a 20 times trailing number. When CPI is over 3%, that PE ratio is typically 15 times. So you have a pretty wide gap there as well. So I don't think earnings misses are going to be taken well, especially with the run the S&P has had from its lows in early October of 14%.
Let me push you on earnings here. Fourth quarter earnings and then early 2023 earnings. Can you give me an adjective of how they're going to look?
Yeah, absolutely horrible when they guide. That's the best adjective I can give you. Because the way you need to think about it is Jerome Powell started raising rates in March. All of that impact of rising rates is really acts with a lag, right? It doesn't act immediately on business fundamentals. And so during a recession, and I think we get one next year, typically earnings go down about 20%. Earnings estimates for the S&P started going down in about July with that earnings season. But they've got a lot further to go. And so really up until now, you've been dealing with more multiple compression to drive the S&P down about 14% from its highs. Next year, you're going to be dealing with earnings compression combined with multiple compression, I think, which is going to cause that problem. And earnings is a much bigger issue, quite honestly, I think, for next year.
And so, yeah, that's what I hear on earnings calls, all about, trying to cut costs. How do you cut costs? You cut employees, you cut office buildings out, start getting rid of those. I think it was Amazon or somebody started doing that. You do what you can, right? And you say, hey, Jimmy, you're fired, laid off, whatever. John, you do Jimmy's job and your job if you want to stay here. And John goes, yes, sir. Depending on how much he's getting paid. But that's kind of in the mode we're in now, right? And so in that contractionary type period, which I showed you yesterday in the data, is showing that happening. One, because, as you'll see in just a minute, we pull so much demand forward. And there's one country that's really feeling that right now. But, talking about trying to plan for 2023 and what stocks is on your list and stuff, the biggest problem is earnings, right? I told you yesterday it's almost impossible, and they're all over the place. I mean, look at 2023. JP Morgan's come out with this today with a consensus 2023 earnings. They think it's gonna be 231 for the S&P. Well, JPM says 205, and they're all over the place. Goldman Sachs come out with something different, but they're all over the place because it's hard to tell, right? Because all the companies don't even know what they're going to be doing next year. And here's some information that came out today as well. What do we know? Personal savings in the toilet. Absolutely in the toilet. It's going back to 05. Once we reach that level, I don't know when they even started tracking this, but it will go back before that, right? Then you got technology job layoffs, right? These are good paying jobs. Bam, looks like a meme chart, does it not? I mean, that's a pretty big spike for 2 months, right? And then look at this right here. South Korea, you want to talk about pulling demand forward, how they're feeling it? Look at what's going on with their exports. Another meme chart for you. It's just falling off a cliff since 2021. Look at that. Straight down we go, buddy. And it's still got plenty of room to drop, right? And so I'd like to know what their employment is on their docks and all that stuff, because I don't think they're going to need those people for too much longer if they still got them. The other thing is risk appetite. This survey just came out today. It goes out to all the hedge fund managers, a lot of them. And if you look, it's in the toilet. It's down at the bottom. Nobody knows what to do because they kind of see everybody's forecasting, Bank of America, Goldman Sachs, you name it, JP Morgan, a recession next year. So they're like, man, do we really want to get into risky stuff or not? That's why you see the Dow moving up so much, right? That's why the Dow's moving up. I think that's why you're going to see TLT move up in the bonds. That's why Bank of America put that out as well, because those are more safe havens to go into, gold, that kind of stuff. You see gold popping, right? But this ain't a bad thing, because look at 08, 09. The NASDAQ 100 bottomed in November of 08, but the S&P didn't bottom until March of 09. And you see right there that they were super bearish from like November into 09. So it's not a bad thing at all, because it leaves a lot of money kind of just sitting on the sidelines. And so, that's not a bad thing. It just kind of lets you know where everybody's at. And then this one right here, I always like to update you if there is an update. I told you about this last week where smart money was actually going up with dumb money, which is us, supposedly, and buying into the rally. When all of a sudden you see the divergence. Smart money's starting to sell. And remember, smart money, big money, these guys sell as the stock market's going up, and they buy when it's coming down. And with these cross, that usually signals the top. Now, is that 100% guaranteed? Absolutely not. They could turn back up and start buying into this. And who knows? I mean, maybe that's what this was all about, right? I mean, you see the SPY, the QQQ have huge outflows after Powell's speech that day of around 8 billion, and then over the next 2 or 3 days you saw 11 billion. People booking profits, because in this market you do not look a gift horse in the mouth. You take your money where you can, because you just don't know where this market wants to go. And so, I showed you some of those option plays and how much money they're making, and people doing the same thing with these ETFs, the inverse ETFs, and they're taking profits when they can. And the reason it's so tough to do that is because, we're in December now, right? And I just put out a members video Wednesday detailing what's going to happen in December to have your money ready, because something, big is going to happen this month. And I know where I'm going to be sitting at, ready to place my bets. And that's what Dan Niles was talking about, right? The Christmas rally is real. I did the research just into bear markets for the members. And so that's what I like more than anything else. And I was stunned by what I found. But, I'll be sitting up waiting for that. And that's where big money, they're probably going to pile into it as well, right? And so I showed you the December data and stuff. I think I gave it to you, was it Monday or Tuesday? And so, we'll have to see on that. But 2023, I mean, it don't mean the market is totally disconnected from the economy anyway. We saw that in 2020 when everything was shut down. Stocks went up like crazy, right? Stocks with no revenue, okay? And so it could totally disconnect and say whatever. But remember, there's going to come a time, right? And I'm putting out another members video tonight, let them know what's going to happen when the Fed actually just pauses rates, or what happens, right? And it's a big thing. And so, you're going to have that time to where the market's going to say, man, when I say market, I mean greedy hedge fund criminals, right? They're going to say, well, we see what's around the corner. Yeah, we think we know what's going to happen. We need to run this sun gun up. We need to run it up, because that way we can short it from here, not here. Okay, and we can ride it all the way back down. That's why you ever notice going into those recessions, you don't think they knew those were coming? Yet the stock market is roaring up, right? And all the data is going down. The economic data is going down. So I've looked at this stuff so much, I know now. It's heading straight down. It's telling them, there's an iceberg ahead, sir. And they just go, yeah, we know. We're going to run this thing up. And then all of a sudden it just falls off a cliff because it gives them more room to short it all the way down. So remember, and I'm trying to teach myself, I'm not a criminal, but I'm trying to teach myself to think like a criminal now, because that's what I feel like those guys on Wall Street are. And so, or how they act and how they do things, especially the market makers. And so if I can learn to think like a criminal more, I think I'll make more money, even more money in the stock market. You know what I'm saying? I kind of joke when I say that, but anyway. So, hope you got some out of that. Hit the like, subscribe button if you did. Let me know what you think about 2023 and what Dan Niles said. Always glad to hear your comments and stuff like that. And I'll see you guys Sunday.